Are commercial valuations the kiss of death for HMOs?
Now, the real problem comes about is when, as a HMO landlord, you start doing HMOs and delivering HMOs in potentially an area that has an undersupply and an over demand. There's then oversupply and under demand because there's so many landlords. You're over leveraged to the point where you're potentially in negative equity because you may be in a position where you're actually having to put money back in because you're getting a lower valuation than you did before. Be very cautious of that cash when it is put to use. Maybe keep something liquid just in case you need a rainy day fund. And I've been banging this drum for a few years, and it actually came up more prevalent so with someone actually at the site tour day on Monday. And I just kind of wanted to bang that drum again and kind of get my thoughts and message out there because I see a lot of people building really successful HMO portfolios and making hay while the sun shines. But I do think that there's a little bit of a trap door that can be found when it comes to commercial valuations for HMOs. Now, the two valuation types that you have in HMOs is bricks and mortar, which is essentially what is it worth as a family home? Granted, it's probably a bit of a weird layout with maybe more rooms than normal, but what does it value as a family home? And then B is commercial valuation, where you take the income, typically the gross income, and then you deduct an operational cost, and then you multiply it by a yield. So wherever you are in the UK, the yield will be different. If you've got a HMO in Zone 1 London, which is pretty limited, but if you did, you might get a 4 or 5% compressed yield. Whereas if you've got a HMO in Nottingham, you might get a 10% yield on that HMO. Now, the real problem comes about is when, as a HMO landlord, you start doing HMOs and delivering HMOs in potentially an area that has an undersupply and an over demand. So you go to an area and you go, wow, I'm buying properties at 150k. I'm kitting them out, spending 100 grand refurbishment costs on them and revaluing them at maybe 500k on the income when the underlying assets, bricks and mortar valuation still might be 250 grand. And the reason I'm bringing this up is because the guy that I was chatting to sort of foresaw this issue. Now, the problem comes about if you're building a really high cash flow portfolio where the income services the mortgages are technically maybe double the bricks and mortar valuation. And the reason that the commercial mortgages are really valuing up really well is because it's your rent roll multiplied by yield. Now, if you then move that market over the course of a few years, maybe 5 years, into a point where that area, other people have saw what you're doing, other people have been on Spare Room and saw that you're charging 795 per bed and you're still buying assets 150k, they're thinking, I need to get in on this. This looks really good. And there'll always be competition in HMOs, and that's just the nature of it. So everyone starts piling in this location that you might have even been an early adopter or maybe even a follower yourself. But then becomes a point where there's so many professional landlords in the area that the room rates then start to quibble down. And what I mean by that is there's then oversupply and under demand because there's so many landlords operating in that particular space. Void rates tend to come longer and more frequent. And equally, the room rates are potentially going to come down because people are competing on price. Classic like price elasticity of economics, if you ever want to look into stuff like that. But essentially supply and demand, and when demand is lower, price comes down.
Love the podcast and all the information you both share. I've just started listening to them all from the start after hearing a couple of them getting hooked. Such valuable information. I do love your pod whilst driving with a cuppa site to site. Love the podcast, very honest and informative. Listen every week now, and I'm working my way through all the previous ones. Keep them coming. This is the feedback we get from our Property Experts podcast. So if you haven't checked it out, you can go back to the live section on our YouTube channel where you can see all of the back catalogue, or if you prefer audio format, all of the video podcasts are put into audio format for Spotify and Apple Podcasts. So head over there and follow.
Now you've got a locked in potentially 5-year fixed mortgage. You're over leveraged to the point where you're potentially in negative equity and you've got to refinance that asset out. So all of the cash that you're pulling out in the first 5 years might have been logical to potentially hold on to some of that cash for the latter 5 years only if competition is rife, because you may be in a position where you're actually having to put money back in because you're getting a lower valuation than you did before. Something to be really conscious of. And the way that I see most people get exposed is if it's a smaller location and there's not many landlords there, and then all of a sudden people start going there. So I think you're okay if you've sort of monopolized the area, because you'll probably have more success in stabilizing and staying alive compared to other competition. But what you need to be really cautious of is actually those valuations. So if you look at our portfolio, for an example, example, we currently don't actually have any sui generis houses. So every single house that we have is a bricks and mortar valuation. We've got our first sui generis being refinanced in the next few weeks. I'm excited to do a commercial valuation because we haven't done one of those before on our assets. Ben and I are finishing some cluster flats. That'll also be a commercial valuation. I would say that our portfolio is varied. So not all of our stock is commercial valuations. Yes, it's great to get some cash back out. I would just be very cautious of that cash when it is put to use. Maybe keep something liquid just in case you need a rainy day fund. To also touch on that, you might be thinking to yourself, I'm pretty sure your social housing portfolio down in South London is on commercial valuations and a yield-based valuation. And that is completely correct. It is. But the leases in those will not change as significantly because the minimum lease that we sign is a 10-year full repairing lease. It's also LHA linked. So it's not necessarily inflation, but it should increase in line with market rents. And those market rents are actually for local housing allowance, so a slightly different strategy, but the security of rent and tenure for 10 years, which is very, very, very different to security of tenure. Well, actually rolling, the average tenancy in HMOs is about 18 months. So thought that would be worthwhile to share if anyone out there is looking to grow up a HMO portfolio and something to consider. You can do two methods. You can actually do, I'm going to build one portfolio in one location and do maybe some smaller ones that are bricks and mortar that are maybe 5 and 6 beds, maybe some bigger ones that do really kick the shit out of revaluing and pulling a load of cash out. You can even split the portfolio like we have in two locations. We've got a high capital value area location, which is around where we live. Then we have a lower capital value location, which is better for cash flow, which is our stock near Oxford. So you can then split that portfolio and diversify it, or you could do what we're doing and actually not do many commercial valuations full stop, which is something to consider.
If you got value from this video, make sure you click the subscribe button down below and ring the notification bell because we release one video at least every week, so you'll be the first to get notified. See you on the next one.